Now that we've looked at how to calculate the PBO, or the projected benefit obligation, now let's talk about the annual pension expense. Again, in our pension expense, just like our PBO, there are certain things that comprise pension expense. They are service cost, interest cost, the expected return on planned assets, and then the amortization of PSC and the amortization of gain or loss. So notice these first 5 items go into our actual PBO. Starting with benefits paid, the next 4 go into our planned assets. And then interest cost, service cost, expected return, wrong button there. Let's try this again. Expected return, amortization of the prior service cost, and amortization of gain or loss all goes into the pension expense for that year. Now let's talk about these last two, amortization of PSC and amortization of gain or loss. What are those? Well, remember in our obligation when we had a change in our formula, either a change in the percentage or a change in the service years or a change in the estimated final salaries, those two became part of the PBO. Well, those are expenses that we do not expense immediately. We expense them over time. So once they get placed in as a prior service cost adjustment or an actual gain or loss, then that gain or loss and that PSC is actually then amortized over a specific period of time. And that's where that expense comes from each year. So those are the 5 components of our pension expense. Okay, so let's look at problem 2 here and see if we can come up with our pension expense for that period of time. Jason Snyder's pension expense includes a service cost of $10 million. Jason began the year with a pension liability of $24 million. And what that tells us, that pension liability simply means our PBO, projected benefit obligation, our PBO, exceeds our planned assets. In other words, we're underfunded by $24 million, so therefore it's a liability position on our books. All right, and that's what it says here, underfunded pension plan. Our PBO has a higher balance than our PA, our planned assets. Prepare the appropriate journal entries to record Jason's pension expense in the following independent situations regarding the other components of pension expense. And again, just to remind you, there's a total of 5 components that are possible when we get to our pension expense. The service cost of the pension, the interest costs on the PBO, the expected return on planned assets, what we think our planned assets will generate in revenues in a year. That offsets our expense. Then any amortization of prior service costs and amortization of any gain or loss from prior years. Okay? All right, so this first one, our interest cost is 11. Now keep in mind in all of these, our service cost is 10. Our interest cost is 11. The expected return is 5, and the amortization of the net loss in this case is 4. Notice there is no amortization of prior service cost. So sort of find our positioning. Now when we do this worksheet, this is our journal entry where our planned assets is actually the difference between. So let me reset us back to beginning point. That exercise 1 still in there. So when it says we're underfunded, that means we have a credit balance here in our PBO. Our PBO exceeds. What does that mean? Well, not that it gives us the numbers, but what that would tell me as an individual is, let's say our projected benefit obligation has $100 million, which is a credit. That tells me that my planned assets only has $76 million. Notice that would be a $24 million underfunded position. So our pension asset liability is simply the net of these two. If your obligation is higher, you have a credit. If your planned assets are higher, you would have a debit. Now, in this section, the way I treat it is a positive is a debit because expenses are increased with a debit. So if it's a plus here, it's a debit. If it's a minus, it's a credit. That is not true on this side, just in our journal entry, because we're going to use this information here that I've highlighted to actually journalize the pension for a period of time. Okay, let me delete these two because that's not the real numbers. I'm just sort of telling you how they would have come up with that 24. All right, first and foremost, for every debit, there must be a credit. So when it tells me my service cost is $10 million, service cost is an expense. That costs us money. Therefore, we debit our expense. Our expense increases by 10. What else happens? Well, remember, when we talked about service costs, what else was impacted? Well, the projected benefit obligation went up by 10 as well. So that means we're going to do an additional credit here. So we debit our pension expense, we would credit our PBO. Okay. All right. The next thing it told us was interest cost was 11. So we know a cost is an expense. It would debit our pension expense for the interest cost. And then we would actually credit the liability, okay? Because that creates an increase in our PBO. Remember, these first 5 items, again, are part of the pension obligation, okay? The projected benefit obligation. Let me say that right, the PBO. Let me just call it PBO to make life simple. All right, so now the other 3 parts are not part of pension expense, so we do not have to worry about those. So let's go into our expected return on plan assets. That's the next piece of our actual pension expense. So again, the expected return is what we think we'll make on our plan assets this period. And in this case, it tells us that we have an expected return of $5 million. Well, let's think about this. If our assets go up, would we debit or credit assets? Well, we would debit an asset to take it up, so that means the pension expense would receive the credit. So this actually reduces our expected return on plan assets. It's going to take it down, okay? Now, what's the offset to that? Well, it's going to be our plan assets, because if we have an expected return, our plan assets are going to go up. So we would go over here and we would debit our plan assets. Notice that helps to offset the underfunded position, because that makes our assets go up in that case. So actually our assets would increase, okay? Now, the last thing that is last 2 things that are part of our actual pension expense is the amortization of any prior service cost. Again, prior service cost happens when we have a change in the percentage of our formula. So again, if I was to scroll over here, we would create it through this change. Notice it went from 1.5 to 1.7. That's retroactive. So when we recalculate for prior years, that tells us how much more we should have had at the end of the year in our PBO. And so when we do that, it creates what we call a deferred recognition. We actually record it in our PSC here, our prior service cost OCI account, and then we're going to amortize it over time, and over time it becomes part of our pension expense. So when we get down here, this amortization of PSC simply means in a prior year we had already adjusted, so this year we just need to record that amortization. So in this part of our problem, we have no PSC, so therefore we would have no amortization, so that would be 0, okay? And it would also go here if we did, because prior service cost is an account we carry, and then as we consume it or amortize it, it would be reduced. All right, now last thing is amortization of gain or loss. Now in this case, we're actually going to amortize a loss, and as a loss is amortized and becomes an expense, it would actually increase my expenses. So it says my amortization of loss was 4. That would be a credit to the loss account, and then it would be, or the actuarial gain or loss account here, it would be a credit there, and it would actually be a debit. It would increase my expense. Okay, if we were amortizing a gain, it would do the reverse. It would reduce my overall expense, because gains are credit positions. So to reduce those, we would debit the gain and credit the actual amortization. Now, we'll talk more about that. Right now, I just want you to understand that that is the components. So as we amortize that loss, it would actually reduce the loss that I'm carrying on my books. Why is that important? Well, when we're done and we sum all of these columns, they should come up to a neat, perfect balance, because for every debit, we have to have a credit. So if I go in and just really quickly type sum, and I sum this column, what we're going to find is the sum equals 20. That would be a debit for pension expense of 20. So that's the answer to my question there, as far as what is our pension expense, 20. Nothing, nothing. Here we've got a credit of 4. And oops, let me just do the sum across. That way we can see. And we have a credit of 16. So if we were to sum all that, notice down here my sum is 0, because my debits equal my credits. Once we have that bit of information, we can actually record the entry itself. Now, we're ready to do our entry. Now, one thing, this was still from exercise 1, so let's take that out. So let's do our journal entry. All we got to journal is across the bottom, and then split this 16. Is it PBO or plan asset? Well, 21 of it is going to be in our PBO. The other 5 will be in our asset. So notice, credit, debit, gives me a credit of 16. So let's go ahead and journalize that entry. So we've got our pension expense, we know is going to be a debit of 20. We go in and we know that our other assets, our planned assets, we're going to be debited by 5. Also from your sheet, again, pull straight from your actual sheet, our projected benefit obligation, we said we would need to credit for 21. Notice this equals a net liability position of 16, so a net credit of 16. Notice that 16 is right there, that's a net credit, so it's split between our PBO and our planned assets. And then the last thing that we need to record in there is that piece of amortization. And if we happen to have it, which we do not in this case, but if we happen to have any amortization of prior service costs, we would also journalize that as well. All right, so let's skip down here. I'm going to post the solutions, so I'm not going to do the second one. Let's go all the way to the third one because they get sort of repetitive. I figure if I do a couple, you should be able to do the rest on your own. So let's reset here. Again, service cost is 10 million. Our interest is still 11. Our expected return is 5. Our amortization of net loss is 4, but then they add an amortization of prior service cost of 8 to the mix. Now that changes a little bit about what we're going to do here. So let's go back to our worksheet. And I say save off a bunch of these. So let's not get rid of everything. Well, let's get rid of everything. We'll just start here. All right, so we start again with that 24 million. What if? Well, we know our service cost is 10. So remember, service cost impacts both pension expense and our PBO. So it's going to increase my PBO. So that means I get further in debt there. My liability will increase as my PBO goes up. Then it said our interest was 11, so I'm going to debit my expense there for 11. This also causes my PBO to go up because interest cost is part of the PBO. So keep in mind, PBO, if it helps, PBOs are credits. Plan assets are debits. That's your assets versus your liability, okay? So here, as we increase them, we're crediting this account. So that makes our liabilities go further in the hole. We're further underfunded than what we were, okay? All right, now the expected return, it said, was still 5. So we're going to hit our expected return. So just keep in mind, service cost, expected return, and then our amortization is what impacts our pension expense. So the expected return is 5. That's going to offset my liability because that means my assets are going up. So take planned assets here, 0 minus 10 gives me negative 10. Here, 5 minus 0 gives me positive 5. That means we're going to debit the asset. But over here, now remember, the expected return reduces the pension expense. It actually goes down with an expected return. And the last two is the amortization of PSC and the amortization of net gain or loss. So let's look at that. Amortization of net gain or loss was 4. Amortization of PSC is 8. PSC is a prior service cost. It's an expense to us. So as we actually amortize an expense, it becomes part of the expense on our income statement. It's going to reduce the balance in our OCI account. Remember, it will show up in OCI. The net impact to total comprehensive is 0 here. We're just moving it. We simply deferred this actual overall expense. So PSC, as we amortize it, will always increase our amortization, my pension expense. It always takes it up. Amortization of gain or loss. If you're amortizing a loss, it's going to take your expense up. If you're amortizing a gain, for example, it would be the opposite. So since this is a loss, it would be 4. And that means it's going to reduce my loss position, so it'll be a credit over there. Okay? And again, we add it up. So do sum. These are the 5 components of pension expense. Once you have it, your pension expense in this problem is 28. That's what we would record. And then our offsets, we would actually hit amortization of PSC for 8. We would hit the amortization of net loss here for 4. And then we're going to split between the 21 in the PBO, which is a credit, and the 5 in the assets. So 5 minus 21 gives me a net credit position of 16. But again, if we were to add these up, notice you should always come to 0 because this tells us our debit and our credits. Once we have that information, we can journalize it. This is our pension expense. This is going to be cash, which we'll talk about a little bit later. Now, this can be two different things. It can either be amortization of prior service cost, or it can be creating prior service costs. So we'll look at those differences as we go throughout each of these problems. Amortization the same way. Here, we're amortizing it, but up here we would create the net gain or loss position, and here we would amortize it. So here, these two columns, you may have to debit and credit different accounts. But that's the only columns that are that way. And then our 16, we know is comprised of a credit to the PBO and a debit to the planned assets. So once we have it, we're ready to journalize this problem. So we know, first and foremost, our pension expense is going to get hit for 28. Then what else do we need to debit? Well, our planned assets we need to debit for the 5. And that will be the 2 debits. So then what's going to be our credits? Well, we need to credit, we know, our amortization, or, well, let me start make it easy, our PBO. Let's credit it first. Our PBO is going to get a credit for 21. Why did I do it first? Because I want to show you again the net there is that 16 net credit position, which is our underfunded pension, so we've got a liability on our books. All right, now what else do we need to show? Well, we need to do the amortization of the net loss, just like before, and that always goes to OCI. We're reducing that overall. So here we go, 4. And then last but not least is going to be our amortization of our prior service cost, okay? And that would be for our, well, I can't type today. There we go, amortization of PSC. And that would be OCI as well, and that would go in as 8. So here we're amortizing that net gain or loss position that's sitting in OCI, and we're moving it actually into our pension expense. So this has the 12,000 or 12 million, whatever, in expense that moves it from our other comprehensive income into our actual income statement. So remember when you covered comprehensive income in Intermediate 1, one of the items that went in there were prior gains and losses from our pensions, as well as the actuarial gain or loss. So those two things go into OCI to start with, and then we amortize them, and they amortized into our actual income in the form of pension expense over a period of time. All right, so that concludes what we're going to do for problem 2 here. Again, I'll post the solution so you can see problem 3, but hopefully that explains to you what 5 components go into pension expense and how to calculate just the pension expense. The last piece is planned assets, and we will look at that in the next video.